Hello, good afternoon. I'd like to start by greeting our invited speakers and the auditorium, and I'd like to welcome you all to Porto Business School. We have planned for today a virtual roundtable about the current and the future challenges of the risk function in investment banking. Banks have made dramatic changes to risk management in the past decade, largely in response to regulations that emerged from the 2008 global financial crisis, and show no sign of slowing down. Well, no one can really draw a blueprint of what a bank's risk function will look like in 10 years' time, or predict all the forthcoming disruptions due to technological changes or to macroeconomic shocks. But the fundamental trends to permit a broad sketch of what will be the required of the risk function of the future. The trends furthermore suggest that the banks can take some initiatives now to deliver short-term results while preparing for the coming changes. So which are the main trends shaping the role of the risk function of the future? Well, the first one is the regulation will continue to broaden and deepen. While the magnitude and speed of regulatory change is unlikely to be uniform across countries, the future undoubtedly holds more regulation, both financial and non-financial. The second one is related to the continuous evolution of technology and the advanced analytics available. Technological innovations continuously emerge, enabling new risk management techniques and helping the risk function make better risk decisions at lower cost. Data and machine learning illustrate this potential impact. A third trend relates to the new risks that are emerging. Inevitably, the risk function will have to detect and manage new and unfamiliar risks over the next decade. Model risk and cybersecurity risk are a few examples that have emerged. To prepare for the new risks, the risk management function will need to build a perspective on what risks that might emerge, the bank's appetite for assuming them, and how to detect and mitigate them. And it will need the flexibility to adapt its operating models to fulfill any new risk activities. On the top of that, all these trends will have an inevitable impact on the profile of the teams that have this risk management function at their responsibility. So these are the topics we're going to discuss today. What also motivate the open course on Capital Markets Quantitative Approach that we are launching this September, branded by Natixis, where we cover the quantitative methods in finance, and for all the main asset classes are equity, fixed income, credit, and FX, the associated derivative products, pricing models, and hedging techniques. So now I'd like to introduce Jean-François Marmonnier, head of the Risk Business Unit at Natixis Portugal, with whom I have built this open course. Jean-François has started his already long career at Natixis some 13 years ago, being Market Risk Manager and Vice President of Natixis CIB Americas in New York. Afterwards, he went back to Paris, where he assumed head positions in various areas, including transformation, projects and market risks, project, market data, and valuation of product control. And is now in Porto, having the Risk Business Unit. Jean-François, I'd suggest now that you could introduce our invited speakers, while I thank them all for being with us today. But before I'll pass the word to Jean-François, I'd just like to tell the audience to feel free to pose their questions in the chat throughout the talk, and I will pass those questions to the table, okay? So over to you, Jean-François. Thank you all for being with us.
So thank you very much, Claudia, for this introduction, and thanks to PBS for making this live talk possible today. I think we are all very happy to have that kind of event here in Porto on that topic. So today on stage, I would like to welcome three experts of the risk function in investment banking. As you know, when you talk about product offered to client on the capital market side, you talk about structured product for which pricing highly depends on mathematical models. So our three speakers like today, like Christophe, Pascal, and Thierry, they are three experts of different fields in the risk function covering these activities. Let me quickly introduce them. First, Christophe Drozo, PhD in computational fluid dynamics. Christophe has been working in the banking industry for more than 20 years in different banks, and he's now head of model risk management at Natixis. So welcome, Christophe. Then Pascal Oswald. Pascal is a PhD in theoretical nuclear physics. Pascal also has 20 plus years of experience in diverse major players of the banking industry and insurers, from SG to CACIB to Allianz, Exxon, Dexia, and Natixis. Pascal is nowadays head of market risk and counterparty risk modeling. So welcome, Pascal. And last but certainly not least, Thierry Hernu, who is another veteran of the banking industry with, again, 20 years in different senior roles around risk and risk management at Dexia, SocGen, Barclays, EY, and Natixis. Welcome, Thierry. So after this brief introduction, we can kick off. And as a start, maybe Christophe, you could say a few words about model risk management. What is the mandate of your group and in the context of the investment bank?
Yes, thank you, Jean-François, for this presentation. The model risk management is a new kind of risk which emerged in the beginning of the 21st century with the different financial crises that emerged. If we talk about, for example, the subprime crisis, which was a failure in the model to rate the different customers. At the beginning of 2010, 2011, the Federal Reserve Bank wrote a text to explain how to understand what is a model, how to manage it, how to manage the risk attached to the use, to the design, and really the management of a model. So that's why at Natixis we started a few years after that. The starting point was the existing model validation team, which were already in place for many years. These validation teams were in charge of the validation of the pricing functions. For example, for any kind of products used in the bank, there is first a step of independent validation to ensure that everything will work properly when used. But then the model risk management was built on top of that to first identify all the models used in the bank. So at the beginning, there was a restriction or just a focus on the valuation. But now we cover also all the risk models, but also the HR models when there are some, the compliance models. So anything in the bank which is analyzed and assessed as a model is then reviewed by the department in charge of this kind of risk. So the different steps are the identification of the models, different nature of the models, statistical, stochastic, machine learning, AI, etc. So identification, review, and then an approval to use it, and some transparency about the model. We try to diffuse the documentation of the model to all the users so that they can understand it and identify all their weaknesses, so that whenever a model is used somewhere in the bank, we know the risk we take to use it.
Okay, thank you, Christophe. I think it was pretty clear. Pascal, maybe on your side, how would you say that the mandate of market risk and counterparty risk modeling group differs from or complement what Christophe just explained about his scope?
So on my side, I'm in the bank, the model developer for the market and counterparty risk modeling. That means that the teams I manage develop different methodology for risk measures, like for value at risk, like for incremental credit risk, for prudent valuation, and so on. So on my side, I submitted all my model to Christophe, which is the validation unit of the model, and he will give a sign-off. He will point out the strengths and weaknesses of the model and give an approval to use my model in production. So on my side, my main mandate is to develop modeling risk measures and to submit it to Christophe.
Understood. So very clear. Thank you. And Thierry, so you could say some words about like market risk framework mandate and maybe more broadly like how market risk articulates within the risk division with Christophe and Pascal's mandates.
Yes, absolutely. We are at market risk. We are model users. And that means that we use what Pascal just mentioned, the development of his team in terms of risk measures. And so we use these measures in our supervision of the trading activities of Natixis. So overall, the risk division is as a mandate, as a mission to protect the bank against losses that might happen on the trading activities. And we do that across asset classes. So we cover obviously equity, fixed income, commodities, and we cover quite a large range of products. And for this supervision activity, we need really a broad scope of risk measures, of mathematical measures that will enable us to not only monitor the risk that are already in our books and with which we serve our clients, like the industry, but also risk measures that we can use to trying to anticipate the risk scenarios in the market. And that's how we use these measures in our activities.
Understood. So thank you all. I think it gives us a clear view of the different type of risk functions that need to be covered, like when we talk about investment banking. So maybe first, the first challenge I propose you to give us your view on would be related to technology. I mean, there has been, there seems to, I mean, for some years, there is a big focus on investing in machine learning, deep learning, artificial intelligence. It seems to be an ongoing revolution. And as I follow very carefully Pascal post on LinkedIn, I can see that beyond this, there is also a growing interest around like quantum computing. So maybe it's a bit too far like a step for today, but at least on this machine learning, deep learning, on this tech aspect, do you start to perceive impact changing on the risk function, or changes in the way business are run with side effect on the risk function? How would you say like these are opportunities, how these are challenges, and what's the risk of not adapt to it? I don't know, Pascal, do you want to start and kick off?
Yes. So before to answer to the question, probably I would just remind a little bit historical context. So Christophe has already a little bit speak about that. So the risk function has profoundly changed since the beginning of century due to various crises. So the big one was the Lehman one, where the bank had to find all the exposure with Lehman and to manage the default because they have some operation with this bank. So the first main change before the technology change was with this crisis, a new role for the risk function in the bank. So the risk function becomes more central than before the crisis. So for me, the main change is the central function of risk. And since 5 years, I can see that technique has more and more importance because with the Lehman crisis, the regulator pushed a lot of pressure on all the organization so that the organization need to have a good understanding of the risk, a good monitoring of the risk, a good control of the risk. That means that we have to refine the risk measures. That means that we need to improve the model, to increase the complexity and so on. And in bank, there are several models. So probably Christophe will give an overview of different models, but he's in charge to validate almost all the model of the bank. And that means that you need to use machine learning technique to improve the model you have, and especially to industrialize a lot of analysis. So I can give some example where the machine learning is used today in a bank. For example, if you have a model that needs input that needs a time series, you need to set up time series with a good quality. So you are using outlier detection algorithm, which is based on machine learning. For example, the supervisor wants that risk measures are improved. So you need to compute a lot of risk measures, but today the payoffs are really complex, the models are really complex and are CPU consuming. That means that you need to think how you can compute a lot of risk measures. So we introduce what we call generalized pricing model. This is based on some machine learning technique again. And today's there are some exercise since I guess 6 years or the 2 years from the EBA that and bank need to stress that all the balance sheet. For example, you need to use machine learning to translate this macroeconomic scenario to all the risk factors that are in the bank. So you can see that the machine learning helps in the daily work all the people to improve the risk measure. And so it's a real challenge to use it today, and the challenge will be to see over the time the performance of the machine learning model. And so, for example, the supervisor published, I guess, this beginning of year, some article to give guidelines of the use of machine learning models. So on my side, machine learnings on IT skills are more and more integrated in the risk function today to improve the risk measure. And to finish with the quantum computing you mentioned, at this stage it's more a personal hobbies linked with my academic background, but there are some strong initiative and tier 1 US bank who are working on it because I guess in the coming 10 years probably it's a new challenge, and especially I play a little bit with that. for matrix inversion and so. And you can see with this new computer, you can increase the computation. And so you need the computation will be faster and so on. So that means that today you have to invest in the future when the computer will be available. And I read last week that Google planned to sell this kind of computer in 10 years. So there are a lot of challenge in the coming years in the risk function.
Thank you. We have Professor Raquel Gaspar. She's a professor in finance from ISEG, Lisbon, and she will belongs to the group of professors who will be teaching our open course. And she would like to ask a question. Go ahead, Raquel.
It's more of a comment, but it works the same. So first of all, thank you for allowing me to participate. I'm also my field of expertise is fixed income and credit risk modeling. That's stochastic mathematical finance, stochastic models, and so on. But I'm also in a hobby way very much fond of programming and machine learning models nowadays. And I think one of the challenges that those kind of models are facing nowadays is actually related to risk. Like, how can we analyze the models, if you want to call machine learning models, in terms of sensitivity to inputs, to parameters, to make them less of a black box. So we are actually doing some research in terms of sensitivity measures to machine learning models, which is, I think, key if we want supervisors to accept these kind of models, as we need to show model risk and we need to show parameter sensitivity. So I think there is both from an academic point of view and actually immediate application in industry perspectives, quite a room to grow in terms of machine learning. And for people that I'm an economist as well, but I'm more from the models, so stochastic models. So when I face for the first time machine learning models, I see them as a black box and I get suspicious about them. But now things are developing, okay? And finally, we are getting much better understanding on the black boxes. And this, I think, for the industry, it's a trigger moment because as soon as we understand how to develop sensitivity models, then those models will probably be much better accepted by supervisors. So I'm sorry to interrupt the panel, but it was just in line a comment concerning supervision and machine learning models.
No, but really, thank you very much. I think it was a great comment. As like I was going to pass the mic to Thierry, because on market risk side, basically, they need to use this new type of technology in order to deal in connection with the regulator's pressure that requires more and more volume of calculation to be done. And I think that they are starting to use this technique. So maybe Thierry, you want to say a few words on that? And
yes, absolutely. Yeah.
Inspiration on what was just said.
Yeah, absolutely. But just a first comment. It's yes, in our risk activities, we tend to use more and more such artificial intelligence models, but it's already the case on the trading activities. And we see there are now many trading places, not only within banks, but also with asset managers and hedge funds, which apply such a technique, which have applied such technique for many years now. And the challenge first as a risk function is to really get a grasp on what is the risk of these techniques when it comes to trading. So, for example, now we have a robot executing hedges on transactions. We offer also a systematic strategy to our clients through sponsored indices. And so my first comment is really related to not the risk function per se in terms of activities, but first in terms of trading activities. So these activities have really evolved significantly on that perspective over the past 10 years, let's say. Now, when we talk about risk activities, indeed, we have access to more and more data. We have access to qualitative data, and we have access to quantitative data. For an example, qualitative data, we have tweets that we can access from influencers, market influencers. Tweets that can give us indication on where the market is going. On the quantitative side, we have now more and more access to trade, what we call trade repositories. These trade repositories are global places where we can access transactional data, meaning prices of transaction executed by the market. And for our risk function, all these data are key, and the challenges now are to base our supervision, our risk activities on this huge amount of data. And I will now let Celia provide an example of what we have started to do to, how can I say, improve the way we use this data in our risk measures. Celia?
Thank you so much. Hello, I will share my screen. Can you see it?
Yes.
So it's a pleasure to be part of this inside revolution. So using machine learning and these new techniques to help to improve the procedures we have today. And I will introduce you and share with you briefly the tool that we built here inside Natixis, the tendency analyzer, that nothing more is a tool that uses AI to detect outliers. And as a kind of motivation, I can say, obviously, as was spoken here, that if we have wrong time series or time series with issues with strange values, it may impact, from one side, on the VAR, for instance, on time risk measures like VAR that are quite sensitive to these extreme values. And so we may be impacted, and if we avoid this kind of values, we may optimize these risk measures. And as well, on the other side, we may optimize and help the work of the risk analysts, because if we can point out these values and give them suggestions to what to look at, in what day we have suspicious values, it will be a plus. So this is the idea behind this model, and in this case, I think the issues behind the black boxes are not that much so critical, because here the model itself is working more like a flag, a helpful suggestion, and not so predicting itself the value. So we are here saying, just spotting some suspicious point and giving some suggestions. So what I will going to share with you is firstly introduce you the main technique that we use, because we can choose a different path to go through this AI technology. I will introduce you briefly the kind of models that we build, and afterwards share its performance and how does it behave and can help indeed in the procedures that we have today. So just a kind of summary regarding this kind of technology that we use. Inside artificial intelligence, we have machine learning that is a kind of technology that enables the model to learn without being pre-programmed. So the rules no more have to be pre-specified, and the models can learn and reach really high accuracy. And inside machine learning, we have a really interesting area that I really enjoy. In the case of we have a huge amount of data, we really got really good results. It's called the deep learning. So it uses a neural network structure to learn to learn patterns, to connect the inputs, in this case, for instance, our time series, to the outputs. In this case, for instance, saying that it's an outlier or it's not an outlier time series. And so these kind of models are quite powerful and learn by examples. So we show them a lot of examples. And so we are in a big data era. So this is a plus for this, and that's why we see nowadays more and more applications of this kind of technology. So we just feed the model with a huge amount of time series and saying, okay, it's an outlier or not, and it will learn really complex patterns that we don't have to pre-specify the features. For instance, we don't have no more to be dependent on our imagination and, for instance, try to figure out the variation among 2 days or the patterns of the time series. No, the model has all the using this structure. The model has all the ability and freedom to figure out best patterns, maybe non-linear, really strange behaviors that we cannot cross our mind, to try to get the highest accuracy. Connecting the inputs, so the time series, the identification of the outliers, the classification of time series, and as well nowadays we have a processing capacity that it's a must-have also to handle this kind of new technologies. So the GPU is a reality also here in Natixis, and it enables the training of these really complex and powerful models. Just to briefly speaking, our goal is at the end to have a really robust model. And so there are a lot of steps that must be covered, and I would like to emphasize just 2 or 3 here. The first one, for instance, is the labeling itself. Sometimes the difficulty to follow a supervised learning. So when you have a label and you want to direct the learning of your model using a label, sometimes you cannot because you don't have the label. So it's a hard work to get them. But if you can handle this, and we did it, so it's a good news. You can supervise your learning, and really in this case, if we are in a classification model, we can measure the accuracy and be perfectly aware of the amount of errors you are facing or not. So paying attention of the labeling and correct labeling, it's a key point on these supervised learning models. Also, the standardization is a technique that enables us to build a model that it's not depending on the scale. So we may wonder to apply the model not just to one single, for instance, asset type, but a huge amount of them. So this is speed up the procedure of train and also the deployment and the measure of the metrics. So it's a really interesting technique that puts all time series at the same scale, and so the model is no more dependent on it. And the last one, for instance, I can emphasize is the overfitting control. Indeed, these models are so powerful that if we just are restricted on our training data set, it will may appear to get, for instance, 100% of accuracy. It will learn and learn and learn and learn, and to get, for instance, as much as patterns that he can reach the minimum error. But sometimes sometimes it starts to learn, for instance, noise, just patterns that are just related on the training set and will not generalize when we go to a different kind of data set, and we don't want this. And there is a huge amount of techniques to control and to avoid this. and to control the overfitting. So to ensure that at the end we have a model that performs well, not only on the training set where we show the examples and the labels, but in the production, where in different time series. So this just a pinpoint of the main topics, just to show you that model covers a huge amount of points, and at the end we are comfortable and we reach a model with a good accuracy and robust that will perform well in production. And in this next slide, we can see, for instance, some real applications of the model. So we just feed with different data sets, and we can see here in the pictures that the ones that were spotted by the algorithm as having some suspicious value, some strange value. And we must agree that indeed there is huge number of outliers, at least suspicious values on these data sets. So this is far from our training. So this is completely different time series. So this just is like a back testing of our model. We are applying it to different kind of data sets and showing that does this perform well. And this is good because it will direct the market risk analysts to critical time series having, for instance, some issues. And if we, as I said at the beginning, if we get accurate time series, we will get accurate risk measures like VAR. And so this is, if we can use this technology to emphasize and speed up the procedure to identify outliers, it's a really a key point, an interesting point. The good news is that the model not just identify time series with outliers, but indeed in the second step it identifies the location. So it gives for the risk analyst the exact day where the outlier is. So it's not just emphasizing the time series where you must look, but the exact day. So it speeds up even more the procedure to identification and clean time series and optimize our work, our risk measures. And on the right side, for the ones that are more comfortable with these topics, we may see the performance of both algorithms. So the first one identifies the time series with some outliers with 90% of accuracy, which is quite good. And the second one identifies the location with 95%. So even if we can even improve more and more these metrics. And but these are quite referential benchmarks for this kind of methods. And here, for the ones that are familiar as well, you can see that there's no overfitting because after at the end the two lines, the blue and the orange, are close to each other. This means that on the training set where the model is learning patterns, and even on the test, so a completely different data set where that it's not used to the learning phase, we reach the same accuracy. So this is a proof that it will perform well when we go into production and put this with completely different time series. So we have today a model that identifies time series and its location, so the outlier location. And to finalize, for instance, to emphasize this last topic, for instance, imagine that you are analyzing a time series and you have strange behaviors. These three cases that I have here, just as an example, were spotted directly by the model. So we no more have to catch and try to see, oh, I see a huge variation and try to identify where the error comes from. So these models directly in a daily basis or whatever we may define can spot for the risk analysts the time series where you have issues and the day where you should look. So sometimes it may be a big move, like in COVID crisis, we have a huge amount of big moves, but sometimes, like in these cases, we have outliers spotted, and you can see that the accuracy, the model really identify the date correctly where this the risk analyst must look, or where you should look to correct the value. So this is what I have to share with you. So just an example. So the tendency analyzer, that it's a helpful tool in this case. Obviously, we must keep going and improve it with another layers and keep investigating. This is just an application using deep learning. We can also obviously use machine learning or different kind of techniques, but this is a proof that we may use and try to follow these new technologies to improve.
May I interrupt? We do have a question from our audience. It's Kayo Sakalauskas. I'm sorry, my lousy pronunciation.
Hello, Kayo.
How this AI infrastructure to detect outliers did behave in the first days of the last year crisis. Do you have any information about that? Have you applied to that? That's a quite specific question.
Are you talking about, he's talking about COVID crisis, right?
Yes. Yes.
Yeah. So this kind of models react really on, for instance, when you have a peak. So this kind of 1 day or 2 days, really huge values. So what happens on that periods in COVID? Sometimes you see this kind of more smooth moves, and so the model didn't learn this pattern as being an outlier. So it will not saying that these values are outliers, and indeed they are not. So they are moves in the market. So as we can see before, the model reacts to this really once a time outliers. So really extreme values that one day something went wrong, and you cannot see here, for instance, when you have a high big move, but a smooth one. A smooth one. It was not a pattern that was learned as an outlier for this model. So he doesn't spot that as an outlier.
Thank you. I guess you answered exactly what Kayo was questioning. Jean-François, I have another question from Pedro Osorio, and going back a little bit. I have one question regarding model risk management. How do you determine the scope? There were no mention to AML models, operational risk, asset allocation, or stock picking models. So Pedro asks, do you keep a model inventory and assess risk and priorities regularly?
So I think,
well, I can take the question, yes. So effectively, these are all categories that are in our model inventory. We address all the kinds of models. So asset allocation, all the compliance models, so fraud detection, AML, market abuse. I mentioned human resources for CV matching, for example, or competence matching. Of course, the risk models and the valuation models represent the biggest part of the model inventory. But in this big inventory, we have about 2,000 of models spread all over all the activities of the bank, all the departments. And whenever there is a new model, it is submitted to the MRM group for validation and approval use, actually. And I wanted to react to the comment by Ms. Gaspar. This is really important for model risk management to have the challenge at the heart of the activity. So to use new techniques to already known models. You mentioned the stochastic approach for fixed income, for example. This is current valuation for this kind of products. But then if you use machine learning techniques to try other techniques first or to speed up the computation, then you can compare whenever you work in a model risk area, as you have to challenge, you have the choices of techniques. So you can use conventional techniques to assess the risk attached to these new kind of techniques, such as AI or machine learning, deep learning, etc. So the sensitivity approach you mentioned is really key to your approach to really manage your model and understand the weaknesses and the strength of your models. But the way we do things within our group is that whenever there is a new technique which is used, we challenge it with a different technique to be sure that with the two ways we have the same result.
Thank you, Christophe.
Okay. We also, Raquel, do you want to add something?
No, I'm just saying that I fully understand. The problem really is when you do something totally out of the box, out of where you do not have the security of the alternative. I mean, it's just, okay, so if you have a model which is parametric or a well-known model and you can benchmark it against, can do comparative risk analysis. But I think what is missing, and this is what I'm investing in research-wise, I'm in academia, what is missing is proper development of measures for machine learning, for neural networks, for instance, in concrete. So developing a way to measure sensitivity within a neural network, for instance, which for the moment is, as far as I know, it's a bit non-clear how you can handle it, because a neural network per se, it's, the inputs, how many hidden layers, how many nodes, but you don't actually know all the non-linearities that go on and that the model gets. So I was just saying that at least academia is progressing in that direction. Okay, sensitivity measures for neural networks, for instance, but other machine learning models, which I think will help in the cases where there is no alternative, of course, because if there is an alternative, we can do benchmarking.
Yes, you're right. I took the easy side because for valuation it's quite easy, but for fraud detection, you've got no choice. You're right.
Okay, great. Thank you, Raquel and Christophe. We do have another question from Hadi Kalel. That's a bit broader question. Mehdi says, I would like to know, how does Natixis see the future of investment banking regarding cryptocurrencies and its impact on traditional banking? That's a bit broader question.
For sure, we can provide maybe personal opinion. Personally, I don't have anything to comment on that. I don't know if Christophe, Pascal, or Thierry, or anyone on stage wants to say a word.
Well, actually, Mehdi also has another question, but related to directly to what we were saying. I have another question. How does these algorithms deal with biased data? How transparent are they? And can we interpret the process these models work? That's a bit related to what we've been saying, right?
Yeah, that's exactly the issue, I would say. Interpretation of these models. It's all we have been trying to discuss, and saying that probably they are very efficient models. They work so fantastically well. I mean, I surrendered from a mathematician point of view, but we are still, so they are extremely accurate, extremely efficient, and we have to work on interpretability. And once you understand how to interpret what comes out and the process inside, actually, not the output, then you can start risk measuring. So they are not so easy to interpret, would be my answer, but I don't know if the panel wants to say something else.
I could just add that what Celia showed to us is really important in the way that there is a performance monitoring. So whenever there is a result, we try to see along the time if the performance is still the same, or if there is a decrease in the performance, it would be indeed something to analyze. Whenever a model is proposed and used, it's important to monitor the performance and to see if it's still fit for purpose and if there's no bias in the use of the model and the application of the model.
Thank you, Christophe. In the few minutes that we have left before we need to close down, maybe we had planned maybe to talk a bit about like the regulatory pressure, as like it has been and it is still a big challenge. And also we wanted to discuss how all these are impacting the skills of like the young people or the people that we recruit on the risk function. So maybe on the regulatory side, to not to take too long and to conclude on this technology topic, I think the regulator is starting to look at these aspects too. And I think Christophe, you were mentioning like a recent document received from European Central Bank, or no, even like the European Union.
Yeah, it comes directly from the EU, actually. It's a draft of regulation to frame the use of the artificial intelligence techniques, but it's in everyday life, including within an enterprise or within a bank. So this kind of new framework has to be enforced in our bank whenever there is the use of this kind of technique. So we will try to adapt our framework to this kind of new regulation. And as you say, it's quite new. Actually, currently, the new regulations come from the European Central Bank or the Federal Reserve Bank or any banking supervisor. And now it's an overall EU new regulation that we have to adapt to.
So a lot of work ahead, probably. So next, maybe, I mean, as we can say, like these are tons of challenges. They imply like new techniques, hence new skills. And Pascal, on this, like, I'd like to hear you on how these trends have modified or not the skill sets of the people that you would need in your area, for instance.
The skills didn't change. It's more the way the people work that has changed. So the skills we have in the teams is mostly people with mathematical skills, statistical skills, IT skills, and on IT we moved from C++ to Python, and we're using R previously before Python. So the profile is always the same, but the way we work has completely changed because for me, 10 years ago, we worked like in a startup. We had a regulation, but the pressure was not so huge. But since the crisis, the pressure is really high, and so people have to go in an industrial process and to respect the different regulation, especially the audit trail of the model construction and so on. And like in coding, you need to be more transparent, and the code needs to be easy understanding by someone. So for me, the skills are always the same since 20 years, but the way we work has changed.
Understood. And maybe Thierry, on your side, like as I guess in market risk field, it's a mix of a quantitative / more like finance background. Like how do you perceive this, and how does it impact the way teams are built?
Yes, absolutely. So we said that the pressure has mounted from supervisors, and they put the pressure on banks to use more and more data because the data are really available, so that we can challenge our pricing. So that we can challenge our risk measures. And so typically we really need so people who are able to manipulate very large amount of data that are heterogeneous in terms of types. So I mentioned previously qualitative data, quantitative data across a broad range of product markets, locations, and people that with this technique, we tend to go out of what we did in the past with a very specific model. We have now the capacity to come up with very alternative techniques. And so we need people that think out of the box and that are really able to come up with new ideas, be able to test and manipulate data. And any clever idea could be a very a great source of value for the bank.
So a good mix of creativity and quantitative. So
absolutely, yes.
All backgrounds welcome. And okay, very good. So I guess we are almost out of time. So I mean, on my side, I would like to give a warm thank you to Pascal, Christophe, and Thierry and Celia, of course, for having joining us from Paris for the first three and from Braga for the last one. And I don't know if there are questions on your side, Claudia, if you want to say a few words. Or...
Yes, we would have a couple of minutes for one final question, if that's the case. If not, and while we wait, if that's the case for a final question, indeed, to thank you for being with us, not only to Pascal, Thierry, Christophe, Jean-François, and Sylvia, and thank you especially to Jean-François for putting together this very lively talk and this very interesting and focused inviters to you today. Also thank Raquel and Sergio that will be along with us, guaranteeing all the modules of the course you're putting together on Capital Markets Quantitative Approach, and not having any additional feedback from the audience. Thank you all. I think we have a lot of food for thought for the coming days. I guess we would be able to set an additional round table with these and other topics. But thank you so much. And once again, it was lovely to be talking with you today. Thank you all. Bye-bye.
Thank you.
Thanks. Bye.
Thank you very much.
Bye.
Bye.